All right, so in this video, I'm going to be teaching you the ultimate gold trading strategy. Now, this strategy uses everything that is necessary to take good trades. Other than that, everything is noise, all right? What I'm about to teach you in this video is all you ever need to be taking good setups. Now, if you then lose, then it's just about the probabilities, all right? Sometimes the probabilities are going to be in your favor, but if you can trade this strategy that I'm about to teach you right now, you don't need to trade any other strategy, okay? Matter of fact, you don't need to even watch my other videos, okay? If you can follow the strategy and master this, all right? Now, watching is one thing, but then, of course, backtesting and practicing on a live or demo account is other thing, all right? And again, first suggest that you start on the demo account after learning the strategy. And I used this strategy to take a trade today, and I sent out this exact setup in the Discord using this strategy. You can see it right here, and pretty much everyone followed the strategy and made money. And I also made money, and I'm going to also break down the trade that I took using this exact system. Now, please hit the subscribe button if you are interested in more educational content. And it's been a long time since I showed my face in the videos. I'm going to do it more often now. So the strategy, very simple. First thing first, what we want to do is start off on the 4-hour time frame. All right. The reason why we do that is because this is going to be your highest time frame, and we want to be trading in the direction of the highest time frame, the higher time frame, which is going to be the 4-hour time frame. Our entries are going to be on the 15-minute time frame right here. But here's the strategy. First thing first, we are trading gold. You can trade other pairs as well or assets, but this strategy that I use gold for this very specific strategy. Okay. So what you want to do is go onto the 4-hour time frame. Now, once you are on the 4-hour time frame, you are looking and identifying where the price is going. Okay. It's really that simple. So if we are going in the upward direction, then that just means that the order flow, the trend is bullish. So it makes no sense for you to be taking short positions when we are clearly going up, right? Now, to identify this is if we are respecting bullish PDRAs and we are disrespecting bearish PDRAs. So for example, let's say that there was a bearish fair value gap over here and price just pushed up and inversed above it, and then created another higher high. That just suggests that the order flow is bullish, right? Over here, let's say that there was a bearish fair value gap and also there was a bullish fair value gap. So price respected the 4-hour fair value gap, and then it also inversed the bearish fair value gap, and then we are pushing up. Then that is your bias, that is your narrative, that is everything you need to identify the direction. Okay, so here's the strategy. Very simple, very easy stuff, guys. And gold specifically follows this strategy very, very accurately. Like if you're trading the strategy on gold, you're gonna see consistent results. All right, so what you want to do is on the 4-hour time frame, mark out the fair value gaps, the closest fair value gaps that you can see, right? So let's say that there is a 4-hour fair value gap here, and also let's say there's a 4-hour fair value gap over here. Now we can utilize both of these fair value gaps. So we can try to take a trade from this fair value gap first, and if this fair value gap fails, then we can use this. And for that, to know which fair value gap is going to work, we use a couple of confirmations that are very necessary to take good trades. All right. So in this case, what we have is a 4-hour fair value gap. So let's say price taps into this 4-hour fair value gap, right? Let's say I'm going to zoom in a bit, and price taps into this gap on the 4-hour time frame. Now, as soon as that happens, what I'm doing is I'm dropping down to 15-minute time frame. Okay. So we are inside the 4-hour fair value gap, and we have then drop down to 15-minute time frame. Now the next thing is you want to look for SMT with silver. Okay, so that is the correlating pair for gold. Now for if you're trading Euro USD, then you would look at GBP USD or DXY, and if you are looking at Bitcoin, you would look at Ethereum. If you are looking at NQ, you would then look at ES, because they are correlated. All right, so what you want to do is wait for price to tap into the 4-hour fair value gap. Then what you're doing is looking for SMT with silver. So let's say that gold makes a lower low, lower high, lower low on the 15-minute time frame, but on the other hand, silver fails to create another lower low. right? So on silver, we have something like this, where price just fails to create another lower low. Now, from here onwards, to confirm the SMT, to confirm that the SMC is valid, we need another step, and that is CIST. What is that? Change in a state of delivery. Okay, so we have SMT, we are inside the 4-hour fair value gap. Now, the next thing is, let's say that there is a down close candle. All right, so let me just make this, let's make it red. Let's increase the opacity. So this down close candle specifically swept liquidity, right? Now, for us to see a change in the state of delivery, for that to happen, we need the price to close above the body of this down close candle, this specific down close candle that swept some form of liquidity. It could be any low or high. So in this case, that would be a low because we're looking at down close candle. So this candle swept this low. We tapped into the 4-hour fair value gap, and we also have SMT. Now, the SMT is confirmed when we get change in the state of delivery. Now, over here, when we closed above it, that is going to be your change in the state of delivery. The next step, you want to identify your drawn liquidity. Now, your drawn liquidity could be unfilled 15-minute fair value gaps up here, 15-minute, or could be 1-hour fair value gap as well, or simply just look for some form of equal highs somewhere around. So let's say that there are equal highs resting around here. But this could be your drawn liquidity. Now you're waiting for a retest entry. So you would take your entry at the retest of this body of this bearish candle. You would put your stop below the low, and then let me just remove this real quick. So your entry is going to be on the retest, stop's going to go below the low, and you're going to go for this buy side liquidity target, or like I do, you can go for 1 to 2 risk reward every single time, and you're going to stay profitable. As long as you're following this model, you're going to be profitable. Then price comes back below and it just goes towards your TP. Now, here are some risk management things that you need to keep in mind. So at 1-to-1 risk to reward ratio, you are going to go break even, and it really depends on you, but you can take a partial here as well. If you have a funded account, then you have to take a partial, because at the end of the day, you are securing and locking in some profits. However, if you are in a challenge phase where you haven't passed a challenge, then I would not take a partial here. I would try to maximize my profits and hold the trade until 1 to 2. And then, of course, I would definitely go break even at 1-to-1, because if price reverses after 1-to-1, then there's a very slight chance that, not like slight, but like there's a very high chance that price can just reverse and go lower. Okay. So here are the steps. 4-hour fair value gap, price taps into the 4-hour fair value gap. We drop down to 15-minute time frame, right? And then we look for SMT divergence with the correlating asset or pair. Once we have SMT, we look for the change in the state of delivery. Once we have that, we are good to take our entry. And one key thing to note is that your entries must be during London or New York kill zone. So the London session is from 3 a.m. till 5 a.m. Okay. And New York is basically for gold and Forex. It really starts at after 7. Okay. And it goes on till 11. For futures, there's a different timing, but this is the timing that you need to keep in mind. Avoid the time from 6 a.m. till 7 a.m. Okay. Try not to get a trade in that hour, because that is basically a lunch hour. But once you get your entry in between these hours, you should be good to go. And also, if there's a high impact news, let's say that you're taking your entry and right after like 5 minutes, there's a high impact news, then avoid taking that setup. Always wait for the high impact news to be over. And once the high impact news happens, look for some form of liquidity sweep, and then look for a market structure shift or change in a state of delivery in your direction of the original idea, if that makes sense. Now that we have that out of the way, I will give you guys some examples, and then I'll also break down the trade that we took in the Discord today. All right, guys, so here is example number 1, and this is a trade that we took in the Discord, private Discord today. So looking at gold on the 4-hour time frame, we were clearly bullish, right? We are creating higher highs and higher lows, right? And then we're also disrespecting bearish PD arrays. Dude, this is just so red. Let me just make it a bit like that. So we disrespected this bearish fair value gap, and then we are pushing up. Now coming into the day, I saw that we had this 4-hour unfilled fair value gap, so it wasn't mitigated. So I had my eyes on that. So going on to the 15-minute time frame, right when we tapped into this fair value gap, I was looking for SMT of some sort. So now look very closely, okay? I think it was this SMT right here. So we took out this low on silver, but looking at here on gold, we failed to take out this low on gold, right? And then again, we were on the 15-minute time frame. Now look very closely, okay? So this is the liquidity that we swept. So this candle specifically, this red candle specifically swept liquidity. Now for us to take a trade and also validate our SMT divergence, we need to see a closure above this candle's body. Candies, oh my god. So I think I'm hungry right now, bro. I could eat something. But we closed above the bodies, and pretty much that was my director. I didn't even wait for like actually this wasn't my trade here. So what in the ideal situation I would have entered right here, but I came to the charts a bit late. So what I saw that I think at this point we had created another higher high, right? So after changing the state of delivery, we had a higher high, higher low, and then a higher high. Now at this point, I saw this down close candle, and that was pretty much my entry. And that was a limit order. And then I had my stop below the low. And then I pretty much went for 1 to 2 risk to reward. I didn't wait for anything. Even though we had equal highs up here, pretty much I just took my entry at the retest. And that gave us a very clean 1 to 2 risk to reward. And my entry was at around 8 a.m. in the morning. And pretty much we had news at 10, which kind of pumped the price up in our favor. I was break even before the news. Eventually it just played out. So let me give you guys a couple of more examples. All right, everybody. So here is the second example again on gold. So again, we are clearly bullish. You can see right here. We are respecting the bullish order block over here. We are disrespecting the bearish fair value gaps. So that just tells us that the order flow is clearly bullish, right? Now, we had a very big pump, and then we formed this 4-hour fair value, actually this 4-hour fair value gap, right? So we have this 4-hour gap, and we are clearly bullish. So then when price tapped into this gap, I dropped down to 15-minute time frame, right? And then I start hunting for SMT divergence. That is the most important part of this model. We need to have SMT divergence. So we know that that fair value gap is going to hold and push the price up, right? Because there are fair value gaps everywhere. But to know which one is going to work is the most important part. And we find that out by finding and identifying SMT divergence. Now, if you look closely, what we have is this low over here on gold. And that gold, this low was not swept on gold. However, if I look at silver, you can see that we failed to sweep out. We did actually sweep out the low on silver, but we failed to sweep out the low on gold. Now, the next step is, again, we have to look for change in a state of delivery. So you have to look carefully and see which was the last candle, down close candle that swept liquidity. So that was the liquidity that was swept. And this bearish candle specifically swept liquidity, right? Now we want the price to close above the body of this down close candle. And as soon as price closed above it, you could have entered directly because it is not far away from the body, or you could have waited for a retest, right? And pretty much you're always going to put your stop below the low. And then again, we had a clear draw on liquidity, which is right here. And then you could have targeted this, or you could have gone for 1 to 2 risk to reward. And pretty much at, I believe, at 1 to 1, you would go break even here, and then 1 to 2, or you target the clear draw on liquidity. Now, a clear draw on liquidity could be session highs and lows, previous day high and previous day low, previous week's high, previous week low, and the highs and lows that are formed. The first high and low that is formed inside a fair value gap on the 15-minute, that is intermediate term high and intermediate term low. Those are very powerful draw on liquidity levels. So let's move on to the last example, and then I'm going to end the video. All right, guys. So here's the last example on gold. So you can see that we are clearly bullish, right? So one way to identify if you're bullish or if you're consolidating or if you're bearish is to, whenever you like open gold and in the next 3 seconds after opening that pair, you cannot identify the direction of the market, then just leave it. Don't trade. But if you know for a fact that with full clarity that it is going up, you will know it subconsciously, all right? Your brain is trained. If you've been trading for so long, you will know that the market is just going up straight in one direction. But if you get confused, oh, is it going sideways? Are we going down? Is the order flow bullish or bearish? Then just avoid it because the trend is not clear. It is just consolidating. It's that simple. Now, literally, we have this 4-hour fair value gap, right? And we are clearly bullish. Then if we go to the 15-minute time frame right here, look closely, and we have this low. So this low was swept on gold, and do know that we are not trading silver whatsoever. However, I would prefer if we do not take out the lows on gold, because that suggests more like, I would say more power towards being bullish, if that makes sense. So we created a lower low. We swept this low. We tapped into the 4-hour fair value gap on gold, but on silver, we failed to sweep that low. Now, the next thing, you want to identify the last candle that swept liquidity, and that is pretty much this low over here, okay? So this specific candle swept liquidity. Now, what we are waiting for is for price to close above that body's high, right? So we have a closure right here, and then again, your entry would be on the retest. However, there's one way to identify a very high probability CIST in this situation. So you can see that this is a bullish candle that swept liquidity, right? So if you just ignore the bullish candle and go to the last bearish candle, all right, then this could be your high probability change in the state of delivery in this specific scenario, okay? Ideally, you want to see the bearish candle to sweep liquidity, but in this case, we have a bullish closing candle. So I would personally just take a trade right after price closes above the body of this bullish candle, because it is on the lower time frame CIST as well. Now, this could be, a little low probability because the bullish candle swept liquidity, but not the bearish one. But again, on the lower time frame, this is just one bearish candle, or like on the higher time frame, this is just one big bearish candle, if that makes sense. So your stop would go below the low, right? But the problem here is that the reason why I'm showing you this example is this is a complicated example, okay? Now, we don't have a low as well. So we don't have a clear low, right? So in this case, what you could have also done is first, yeah, of course, you could have taken your entry on the retest, but you could have also waited for price to form a swing low, and then you would have taken your entry at the closure here, right? Or you would have waited for price to close above the bearish candle's body, and then you could have waited for price to come back inside this fair value gap, probably like the 50% of this gap, and then you could have taken your entry. So personally, I would have taken my entry at the formation of the swing low, because that's where we put our stop. But if we don't have a low, then we're not going to put our stop anywhere, right? This is not logical. Anyways, we put our stop below the low, and we can just go for 1 to 2 risk reward. And pretty much that was hit right here. We had a retracement to the downside, but then eventually price took out this high as well. Anyways, that's going to be it for this video. Big example, but it was a bit complicated, so I want to show you that as well. I'll see you guys in the next one. Take care. Goodbye.